Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm joined by John Bolton with his Squirrel Money hat on this time, which is the new peer-to-peer lender which recently launched. John, keen to have a chat about peer-to-peer lending and how you're going with that. Now, you're obviously up and running. You have been for a month or two now. I mean, how much lending have you facilitated thus far? What sort of loans are being arranged? And for what sort of things are people borrowing money for, and what sort of loan terms are you seeing?
Yeah, okay. So we obviously do secured and unsecured personal loans, so which is interesting. So I'll cover that off. Look, we've started intentionally pretty slowly. One of the key things for us is that we have intentionally not put a bank or investment bankers behind the platform, so that all of the funding that's raised has to come from retail investors. Now, that means that you've got to be a bit careful and you're going to be a lot slower in terms of how you lend out. The way I view it is it's going to be a bit of a growth curve. It's going to be sort of slow to start with, probably for the first 6 to 9 months, but we'll see it sort of steadily increase as investors get more comfortable with the way that we're doing things. It's very much, our growth rate's very much going to be dictated by the investors. The more money that's invested through the platform, the more we can increase the amount that's lent out to borrowers. There's no shortage of borrowers out there. What we've learned very early on is that we can dial that up or down at will. But obviously what we want to do is not have too many borrowers in the platform, because there's nothing worse for a borrower than sitting there not having their loan funded for an extended period of time. So it's a delicate job, but literally we sort of try and manage it so that we've got reasonably even balance between investors and borrowers. So we've put in, I think we'll go over 600,000 today. We've been going 4 weeks, and that 600,000, average loan size is probably around 20,000. We haven't actually done that much secured lending yet. I thought we'd do a lot more. I think that's yet to come, partly because with the volume still quite low, those bigger loan sizes are definitely harder to fund at the moment. The sort of stuff that we're seeing, we're doing a lot of A and B grade loans, so high quality. I think we have hardly written anything lower than C grade, and our intention is to keep it that way. We really want to stay in that sort of bank quality end of the market. Most of it relates to car purchases, debt consolidation, or just sort of tidying stuff up basically for people. There's nothing extravagant in there. Maybe a car could be considered extravagant, but it's pretty simple. Yeah.
And I mean, so if you're staying in that sort of, the top end of the lending market, I mean, are you rejecting a lot of people who are applying for loans?
Yeah, look, we've been very careful not to scorched earth direct market the entire country. So that's a bit of a theme for us. It's about being intelligent and being very smart in terms of the market that we're talking to. There's no point talking to people that we have no intention of lending to, we don't want people to have a negative experience with the brand. So we're trying to be really focused and targeted with that. So for me, I mean, the perfect thing would be to have a low rejection rate, because it means we're actually doing a good marketing job. I would say at the moment our rejection rate is still pretty high. We'd be rejecting probably somewhere in the order of 70 to 80% of applications.
And what sort of people are coming on board as investors or lenders at this point?
It's a funny one. With early adopters. So we're a new technology platform, so we're getting sort of early adopters that are throwing small amounts of money in, and initially we're trying to game the system, which threw us out a little bit because we kind of weren't anticipating that. We thought that we'd get rational investors from day one, and there was a bit of gaming going on in the platform, but we've kind of adjusted to that as we've got a bit more experience. So early adopters very much. A lot of people just putting small amounts of money in just to see how it goes. And I guess you'd expect that. It's only been going 4 weeks. So, their first interest payments are going to start to come out in the next week or two. and then I think gradually from there, you'll start to see a bit more confidence, and they'll see how it's working and how it's flowing, and you'll start to get a bit more money in, and it just kind of grows on itself from there.
And what sort of interest rates are you seeing in these early days for both for borrowers and investors, and what terms are the loans for?
So the vast majority of the lending's 5 year, and that reflects the loan size. When you're getting 20 to 30k loans, most borrowers need to put those over sort of 5 year terms. Which makes it interesting for investors, because typically, investors don't have a long investment horizon. 5 years is a long time. What we've been sort of educating investors on is that you've got to remember that these investments repay like a loan. So you've actually got principal coming back from day one, and 32% of the principal on these loans is actually getting repaid in the first 2 years. So although it's a 5 year investment horizon, the reality is at the end of 5 years, all of your capital has been repaid. So there's a little bit of a mismatch there at the moment, in that the vast majority of borrowers are going in for 5 years, and investors typically are liking the 2 to 3 year term. As far as rates are concerned, the interest rate at 5 years at the moment is hovering around 8.5%. And with those shorter terms, we think they'll settle down around sort of 7.5, maybe 8.
So that's for borrowers and investors?
That's for investors.
Sorry, okay.
And you've got to remember with our platform that the rate is after money has been passed up to the reserve fund to protect the investors from credit losses. So the reserve fund essentially underwrites the credit losses, so that's the return that the investor could expect to receive. As far as borrowers are concerned, I guess the rates are probably somewhere between 10.5% and 13.5%. Tends to be where that's sitting. We're not really getting it below sort of 10.5 at the moment, because there's not enough investors in the platform yet for competition to start to, I guess, lower those funding rates.
Now, you're matching borrowers and lenders 1-to-1, so you're not. The lenders aren't fractionalising their investment around different borrowers?
Yeah, that's right.
But you have, so that's obviously what Harmoney does in terms of protecting investors, but you have the Loan Shield product.
Yeah.
So can you tell us a little bit about that and how you think that's going to work?
Okay, so probably the first point is that Loan Shield works the same way that a bank manages its credit risk. Right, so diversification of credit risk across a portfolio is absolutely the right way of getting rid of risk. Yeah, spread the risk across a portfolio and diversify the risk. There's two ways that you can do that. As an investor, you can invest small amounts of money across thousands of loans, in which case you need to spend a lot of time looking at a whole heap of loans and assessing the risk of each loan, and then building a portfolio up, and very time consuming. Or you can take our approach, which is how a bank would do it, which is to pass the credit risk up to a mechanism that essentially diversifies it across the entire portfolio, which is what the reserve fund does, and therefore pass the benefit of that diversification straight through to the investors in totality. So and we get asked about it. So roughly about sort of 2.5% absolute, which is about probably a quarter of the actual interest paid by the borrower, is passed up to the reserve fund. So the reserve fund will grow over time. As the lending book grows, the reserve fund grows. If a borrower misses a payment, the reserve fund pays it straight away through to the investor, so that the investor gets their regular return. We're reserving at 4%. Of the total lending outstanding. Our expected credit losses sort of run between 1.2 and 1.5%. So we're sort of reserving over 2 times what we expect in terms of credit losses. So that reserve fund will continue to build up faster than the losses we would expect on the portfolio. And so that's basically how that reserve fund works.
Now, we've obviously got the Commerce Commission looking at whether peer-to-peer lenders' fees are covered by the fee provisions of the Credit Contracts and Consumer Finance Act. And we've seen recently Harmoney make some changes to their fees for borrowers. You've obviously started out with flat fees, $250 fee for unsecured loan, $500 for secured loans, and then the 2% platform margin for investors. Are you're confident and comfortable, I assume, that there won't be any issues around the fees that Squirrel Money is charging?
Oh, absolutely. We always took the approach that whatever we did would be compliant with triple CFA. But for us, it was much more than triple CFA. I mean, it's a guiding piece of legislation. But for us, it was actually about making sure that we had a proposition that stacked up in terms of where we felt peer-to-peer sort of sat in the spectrum. I mean, at the end of the day, you have to be delivering a better proposition into investors and borrowers than they can get elsewhere in the market, right?
So whether it be banks or other peer-to-peer lenders or finance companies or whatever?
Absolutely. So for us, a low upfront fee for borrowers and really competitive interest rates was really a starting point for the entire platform. And for us to be able to basically remove the credit risk for investors, to give them a low-risk investment, make it as easy as possible for them to invest, decent chunks of money as opposed to $100 here, $100 there. That was critical as well, and to deliver a low risk return well above what they could expect to get in the market.
Now, you've obviously got your mortgage business as well. Are you seeing and or expecting much crossover in terms of the mortgage customers using Squirrel Money as well?
Yeah, look, we haven't to date. I'm pretty relaxed about it. As I said, most of the lending that we've done so far is unsecured. Different markets. I think we are going to see a bit of crossover there over time. We're not really seeing it in a big way at the moment, but I think it's too early. Probably when the market sort of starts to shift a bit and things get a little bit tighter and the banks get a little bit harder to deal with, that's when you'll sort of start to see that coming through a bit stronger. At the moment, with the significant lift in property prices that we saw, particularly in Auckland last year, a lot of people have now found themselves below 80% LVRs. So things are pretty settled in the housing market at the moment. But things change; they always change, and when they do, and when we sort of start to see stuff a little bit more outside the box, I think there will be an opportunity then to get a bit more crossover between the businesses.
Thanks a lot for that, John. That's John Bolton from Squirrel Money, and I'm Gareth Vaughan at interest.co.nz.